What's up? Welcome back to another awesome YouTube video. This is T.Mayne, your FX Chasers mentor speaking. I'm so happy and I'm so glad that you guys are on this YouTube video, on this YouTube channel. Guys, if you are not a subscriber yet, please do subscribe to the channel. I would love it, I would appreciate it. And guys, also the comment sections are yours. If you guys would like to go in depth on any concept, on any topic, maybe something that I haven't thought of myself, just let me know in the comment section below what you would like to go into in our future videos, and obviously I will take the time out to make sure that you guys do get that value that you are looking for. Now in this video guys, we're going to get into why does the market move. So in general guys, we know surface level, we have a surface level understanding of the fact that markets, yes, they move to the upside, markets also move to the downside. We find consolidations, we find impulses, we find corrections, we find all those hundreds of thousands of things guys. But in this video, we're going to go into the details underneath a deeper understanding of why are the markets actually moving the way that they are moving. Now, to kick this video off, guys, I'm gonna just basically run through a few concepts that we're gonna need to understand that are important for us to understand to actually continue with this video, and so that you guys do get the most value out of this video. Now, I didn't tell you guys to like this video yet, because I actually want you guys to watch the whole video, then decide if you have received some type of value from this video, and then go ahead, like this video. But anyway guys, let's get into this. Like at the end, not at the beginning guys. So let's get into this guys. So first of all, we know that markets love to be balanced. Markets, obviously we know the only two types of market participants that there are buyers and that there are sellers. And at any point in time, the market wants to find areas where there are both buyers and sellers. The market wants to find those prices or those areas of fair value where both buyers are interested and sellers are interested, and there are two-way transactions that are happening across or at those particular price regions. So you guys do see here, I have buy, I have price, and I have sell. So we know generally what the markets look like. Obviously markets function on two axes. We have the x-axis, which represents time, and we have the y-axis, which represents price. So we know any market has those ups and those downs, consolidations, breakouts, retests, whatever the case is, all bound by these two axes, which is price and time. So what the market is showing us is basically what market participants are doing over a period of time, and what they are doing at specific price levels, where either sellers are more interested or buyers are more interested, or things are equally matched. Now, to kick things off guys and get into the actual meat of what we're here to speak about, let's just create a hypothetical situation. We have whatever asset this is, we have no idea what asset class this is. This could be a currency, it could be a stock, it could be anything. As long as we are trading a chart that represents or that has a function on price and time, then this is applicable. So let's just say we have this market that's trading at 87, and for whatever reason I think 87 is a good place or a good price to become a buyer. And so I buy 5 lots of this particular currency. Now what happens after I've bought 5 lots? Obviously there's an imbalance. We can see that there are no sellers that are willing to sell this market. Now let's just say for whatever reason that at a price of 90, my friend decides that he loves this price, and he thinks that if prices get up to that point, he wants to sell. So he places a limit order to sell, let's just say 7 lots of this particular asset at that price of 90. Now what happens? Because there's an imbalance and I bought 5 lots at price of 87, what happens next? Price begins to move to the upside, because what is price doing? Price is looking to match me, the buyer, with another seller. So there's an imbalance within this area. We do not see any sellers that are active in this area. Hence prices are moving to the upside to look for sellers. Now price moves from 87 all the way to 90. We find my friend over here that decided to sell or place a limit order of 7 lots when price does get to this area here. 5 minus 7 is obviously 2. So there's an excess of 2 extra lots being sold. So So when price does get to 90, obviously we'll see a reversal happening. Prices will stop at 90 because 90 is a price region where the sellers exceeded the amount of buyers that were active in the market. So we'll see prices make a move to the downside until they find some more buyers. Now let's just say, obviously because prices are going down, buyers are going to be interested. Let's just say at 88, someone decides that they want to buy 10 lots of this particular asset. So prices obviously move to the downside. Remember, there was an excess of 2 extra lots. There were obviously 2 extra lots from the sellers. So prices end up moving to the downside until they get to the price of 88. What happens when they get to 88? There were 2 extra lots of sellers, so obviously 10 minus 2 is 8. So we have a surplus of 8 lots being bought more than there are sellers. So then price begins to now move to the upside to look for those sellers. Now remember, we have an excess of 8 lots, so let's just say for whatever reason someone decides that, okay, 91 is a beautiful price, I'm gonna sell 9 lots of this currency. Now remember, now at this point there's an excess of 1 lot. Let's just say for whatever reason there's someone here that decides that they want to buy this 1 lot. What are prices going to do in this area? Remember now, buyers and sellers are equally matched. Now this then becomes an area of fair price, because this is an area where sellers are interested as well as buyers, but there's an equal amount of sellers and an equal amount of buyers that are interested in buying and selling and exchanging value at this particular price region. Now obviously things are balanced there, the market is not moving at all. Now let's just say for whatever reason someone else decides that they want to buy 2 lots. So obviously we know that prices are going to make that move to the upside, and then for whatever reason someone is willing to sell to sell 3 lots. So now there's an imbalance, there's 1 more lot being sold than there is being bought. So prices will make that move from 90 until they find another seller. So let's just, another buyer. So let's just say obviously there's 1 extra lot that's being transacted over here, so prices are making this move to the downside. So let's just say, for example, 3 lots are being bought in this area, so obviously now there's an excess of 2 lots. And now what I'm trying to point out for you guys is, if we look at how price made this move to the upside, very nice impulsive move to the upside, and when prices are in this area or in this region, let's just use this whole these 3 digits as a region where prices are basically balanced, where both buyers and sellers are balanced, both buyers and sellers are interested. Price is going to consolidate within this area because there are 2-way transactions that are being made. Now why is this actually important for us traders? The reason why this is important is because now we have an in-depth understanding of why markets impulse to areas, why markets consolidated certain areas, why there are break and retest of areas, why there are impulses followed by corrections, followed by continuations of the next impulsive move, is because of this shift of balance between buyers and sellers. When there is an excess of buyers involved in the market is going to move to the upside, looking for an area where sellers are going to be interested. Obviously, remember we said in the beginning that the market always wants to be balanced. The market always wants to have an equal amount of buyers for every seller. Now, we'll speak about something called a consolidation. Now, we already spoke about the dynamics of a consolidation. Obviously, there's an equal amount of buyers and sellers involved in this consolidation. So let's just I think I'm prepared to erase all of this, guys. Hopefully we understood this whole concept in depth and with a lot of clarity. Now let's move on to how we can actually apply this in our trading with this deeper understanding of why markets do what they do. Let's just say now we have a consolidation that's happening, obviously a ranging market. We have maybe potential equal highs and we have equal lows. Now what can we derive from this consolidation? The one thing we can derive is that within this consolidation, both buyers and sellers are interested. So that means that there is a fair price somewhere in the middle where both buyers and both sellers are attracted to. So what happens after every consolidation? Eventually, the balance shifts and we see either buyers sending prices higher out of the consolidation, or we see sellers sending prices lower out of the consolidation. Now, just for example's sake, let's just say sellers were dominant in this particular scenario and prices managed to break below this consolidation. Now, the fact that prices broke below the consolidation means that whatever was happening, all the transactions that were happening within this consolidation, there were more sellers interested than buyers. And we can see that because prices broke to the downside of the consolidation. Now, what happens upon this retest? Why do we love trading breaks and retests? Now, we understood that within this consolidation there were both buyers and sellers. Sellers managed to push prices lower outside of the consolidation. So obviously all the sellers are in profit because they've sold within this consolidation, prices move lower, so they are in profit. Now what happens when prices come back into this area? Very interesting thing, guys. One of two scenarios is going to happen when prices come back into that fair value area or that value of consolidation. Either all of the sellers that managed to push prices lower are now seeing an opportunity to jump back into the market at more higher prices. Obviously, because we know sellers are interested in high prices, buyers are interested in low prices. So prices went low and prices are going up again. So all of the sellers that were interested in this market over here, they're going to want to do one of two things. They're going to either want to protect their original positions, because remember, once the market impulsed down, they were in profit, and now the market has pushed back up, so their positions are obviously in less profit, so they're going to want to protect those positions by either adding more positions or getting out of those previous positions. Now, another thing that can happen, guys, is that all of these sellers that were involved in here could now see prices. Because prices are going higher, they could now observe that prices are at a better deal and decide to continue adding those short positions, because now they see that they have another bargain to enter prices high than where prices actually pull down to. So that hence we find those breaks and those retests of structure. Obviously, those retests are where us as retail traders get those good probabilities, guys. So to just basically sum up everything that we've been speaking about, the reasons why markets actually consolidate and the reasons why markets actually impulse to areas of value is because when markets are consolidating, they've found an area of fair value and they are both buyers and sellers transacting at the same time. Remember, that's what the market wants to do. The market wants to match both buyers and sellers, and that's why markets spend a lot of time in consolidation, because markets want to do that for as long as they can. And the moment there's an imbalance between the buyers and the sellers, like in this example, we saw prices breaking down, that's when we find markets impulsing down to find new areas of fair value. Now, after this impulsive phase, eventually what happens is we do see markets begin to correct again, establishing a new area of fair value. So prices are always looking to match both buyers and sellers by finding those consolidation areas. And the moment there's an imbalance and prices break outside of those consolidation areas, prices impulse to find the next area of value to match both buyers and sellers once again. Now guys, I hope that you guys have got a ton of value from this video. This video has been so deep, so expansive on our basic general knowledge of why markets move to the upside and to the downside. And guys, if you have received some type of value from this video, this is the time where you should be giving this video a thumbs up. I would appreciate it, and the YouTube algorithm would know that you guys actually received a ton of value from this video, and it's going to show other people this exact same video because it knows you've received a ton of value. So if you would like other people to also receive a ton of value, definitely give this video a thumbs up, and other people that have not been able to come across this video the way you did will be able to receive this exact same value. Now guys, I hope that you guys learned a ton. We discussed balances, we discussed imbalances, we discussed the whole fundamental nature of the market looking to match buyers and sellers. And guys, this is T.Mayne, your FX Chasers mentor. I'll see you guys in the next value-packed video.